Barangaroo Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Good afternoon to you. Wonderful to be here with you for the COB. I'm Nadine Blaney, and joining me today, Martin Crabb, who's the CIO at Shaw Partners. Let me, though, before we get to Martin, just set the scene. I did channel this day today, I'm going to say, with my green jacket, up by 0.7%. Market momentum into the close. I do believe we will print a fresh record high for the S&P ASX 200. Of course, we'll let the last of the day's trades go through, but that's what it's looking at right now. And we had a bit more wind in the sails of this market in the wake of that China data that came out. So GDP coming in, well, better than expected. And so that's brought the prospect of a record reset here in Australia to the fore. China connection. So we just did a really interesting interview with the head of ANZ's China strategy, who said, not so fast when it comes to this enthusiasm about the Chinese data. He still sees quite a lot of pain in the housing market there. However, let's not take it away from that GDP beat that did come through today. And of course, that gets us set for the next big data point to come tonight, which is the US consumer inflation read. So that's all about inflation, looking for any evidence of the impact of tariffs and all of the uncertainty around the trade regime between the United States and the rest of the world. I will put a PS. We should have done 4 themes today because US earnings pick up as well. We had a record reset for the NASDAQ through the overnight period, and that really lit a fire under the tech space here locally. Look at Technology One, up 2.3% to $40.18. However, I've got to just give a special shout out to Life 360, topping the leaderboard by percentage change, up by 7.6%. Healthcare, we'll talk CSL in just a moment, but it did really well today, up by 3.7% to $250.71. Generally speaking, the healthcare names did push higher. And taking a look at utilities, I dare say that this might be a little, no, I don't think that we can bring that up. But safe to say, if there was a weaker sector today, it was the materials throughout much of the session. BHP still ending the day down by about 1%. Hub 24 shares, for some corporate news, reached a record intraday high after saying funds under management increased 10% in the fourth quarter. Media actually rose despite being informed by the Auckland Transport Authority that its contract, which was due to expire at the end of the September, will not be renewed. Tyro, yeah, it did really tank. It's recouped some of its losses. The RBA says that it's looking to ban surcharges on all debit and credit transactions under FPOS, as well as MasterCard and Visa networks. Of course, it still has a consultation before the final proposal gets handed down at the end of the year, and then it would be up to the government to legislate that. And Paladin shares rose after Bell Potter retained its buy rating, but upgraded its short-term target price. CSL, I said, it hit a 1.5-month peak on plans to trim its R&D division. Apparently, it may cut about a third of its 2,500 R&D staff, according to reports. And Pangana, well, that's a good jump, up 10% on higher funds under management. In the smaller end, Jennison hit a near 4-month high on a contract win. Iron Drive, it was positive today after securing a project to upgrade recovered graphite. And yesterday, Hansen upgraded its outlook, and today adding a further 5% as brokerages are still upbeat after that upgrade. Let's get some analysis. Martin Crabb from Shaw Partners joins us now. What do you think? Momo pushing this market higher.
Feels like a bull market to me. You got the green jacket on, say no more.
Yeah, so if it looks like a duck, acts like a duck, it's a duck? It's
a duck, yeah. It's clearly some of the price moves today, and obviously the momentum offshore. I think also during the day on the wires, NVIDIA was cleared to sell some of their chips into China. Mm-hmm. So I think the NASDAQ futures sort of popped on that and just gave a bit more leg to the market. So yeah, a lot of buying out there, and as you said, the only real sector that was holding it back was the resources. And if you look a couple of days ago, the resource shares are all 4 or 5% higher. So they were just giving back a little bit of their gain. So, more broadly speaking, it looks like the market wants to go higher from here.
So when you get data points like that out of China, does it get you excited about that rotation from banks into resources?
Not so much so, because I think everyone knows that China's, evolving from a fixed asset investment and infrastructure and housing, led investment story to more of a consumption story. I mean, that's been clearly, spelt out by the Communist Party there. And so the stimulus is not going to be in the form of let's build more apartments, because they've got something like 13 million square metres of unsold apartments. It's more than all the building stock in Australia is sitting there unsold. So I don't think it's back to mama. But I think most people have understood that China is clearing out a lot of their low value and dirty iron ore and coal. So they're sort of reducing supply of some of the poorer quality materials, and that's keeping the iron ore market tighter. So we're starting to see $100 iron ore, and most analysts have iron ore going 80, 70, 60, and it's just becoming more obvious that iron ore is probably not going to do that in the time frame people thought. So we've seen upgrades pretty much across the board to all of the iron ore miners and some of the coal miners as well. And so people are just buying from an underweight position. I think one of your early speakers said the market's pricing in lower iron ore, so if it doesn't happen, everyone's got to upgrade. And the market's already positioned for lower iron ore. So these stocks collectively are bigger in the index than CBA, and everyone talks about CBA. You need to own it because it's so big. If you add BHP, Rio and Fortescue, you're looking around about the same weighting. So they're very under-owned stocks, and if they are going to hold up at $100 or $90 iron ore, they'll probably come upgrades from here.
Interesting, one to watch. Now, in corporate news today, we've got that quarterly update from Hub24.
Yeah.
It's just going from strength to strength, it seems.
It's a stock that's very difficult not to love. I mean, I infamously had a sell recommendation on this stock about $95 ago when I was first covering it, because it ran too hard back then, but it's subsequently gone up 20-fold, because this is a top performing business in a sector that's growing structurally. And when you find the combination of those things, you can get fantastic performance, exactly what we've seen from Hub today. So up through $100 a share, which is, this stock traded below $50 on Liberation Day. So it's amazing how fickle the market is, right? But these guys are operating an investment platform. It's considered the best amongst the advisors, independent advisors. They've got the highest net promoter score, which is what you look for. Is most of the people that use it love it, and they also advocate it to their friends. So it is gaining market share. It's up to about 8.7%, which is a gain of almost over 1% in the past 18 months. So it's gaining share, but more importantly, that market, that self-managed super, independent financial advisor market, is growing like topsy. We've got $4.5 trillion in super, 12% of the national wage. So they're growing share in a growing market, and that's what you want to see from a growth stock. So off to the races today.
Yeah, and so you don't think it's looking too exy? I mean, would you be tempted to trim some profits?
Absolutely. So for those investors that have got a big, we're lucky enough to buy it either, back in April, even years ago, you could have picked this up in single digits. You're probably sitting on some massive gains, and it's becoming a very large part of your portfolio. So don't be surprised if you see some trimming of positions, just because investors need to get their portfolio balanced. They can't have it all in one stock. So we at Shaw and Partners, we've got some very big holdings in some of our portfolios, and we'd use strength in any stock, not just Hub. If we start to get a bit too heavy in the stock, we'll trim it and we'll look to rotate into stocks that have underperformed. So at the moment, you're seeing a lot of money being trimmed out of things like the banks, which have run really hard, and into pharmaceuticals. So some good positive moves in pharmaceuticals. Those stocks have underperformed a lot, especially CSL. So investors look to rebalance their portfolio. You take some money off a stock that's run really hard, like a Hub or a CommBank, and you put it into something that maybe is underperformed, that starting to look interesting, like CSL.
Okay, so we're in a bull market.
Yeah.
Does it continue? How are we impacted by seasonality?
Yeah,
at this time of
that's
year?
an interesting one. So one of our research partners, UBS, published a note overnight just saying that, look, we've probably got a period of consolidation before we head higher into the new year. And one of the factors they talked about was seasonality. Now, they were talking about US seasonality, but it did prompt me to go and look at seasonality in the Aussie market. So the All Ordinaries has been around probably since the 1930s. Certainly the data in IRIS takes you back to the 1930s. So I looked at every month and just said, okay, on average, how much does it go up? This is in price terms, doesn't include divvies in each month. And you can see that all of the return in Australia happens in 4 months. So if you want to be really cute, you basically buy on the 1st of December, you sell at the end of January, then hop in again for April, hop in again for July, but you can sort of sit it out from kind of now all the way through into the start of December. So we do have this sort of seasonal period where things are a bit flat to down in August, September, October and November. Some of that is explained by reporting season. So companies tend to report their profits in August and September. And so, sometimes they disappoint. You do get a bit of weakness. You also get stocks trading ex-dividend. So this is just looking at prices. So when stocks pay dividends in February and August, September, the price tends to come off. So the seasonality is also very apparent in the S&P. This goes back even further. And just August, September and October, less so August, but September and October tend to be softer months there, less around dividend payments because they're not big dividend payers. But just it's not a sell in May and go away. It's more a sort of sell in August and go away in both markets. So just another reason. I mean, the market's had a good run. Coming into earnings season, a bit of nervousness. Who knows what the tariffs are going to play out? Maybe we're in for a period of consolidation. We're not saying sell stocks. It's just probably more of a time that you can take advantage of weaker or sideways prices to rebalance your portfolio. Make sure you're fully invested.
Mm-hmm. Because we've also got August reporting season coming up, which will occupy a lot of time. But the big risk event on the horizon right now, though, is that U.S. inflation report.
Tonight.
So what are you expecting? Do you think that our expectations for interest rate cuts there will change fundamentally?
Yeah, I mean, I think the market's pretty much of the view that the Fed is on hold, despite the rantings of the president, who'd like, obviously, Jerome Powell to cut rates to 1%. But, it's really difficult for the Fed because it's clear that the economy is slowing. The labour market's starting to soften. But, you've got this inflationary impulse, which we're going to see in the data tonight. Core inflation and headline inflation both be 0.3 consensus, and that'll push the annual numbers up to 2.5% to 3% for both core and headline inflation. And that's going in the wrong direction. So if you're the Fed Reserve, your job is to get prices under control, and you want them heading towards 2, not heading towards 3. So when they're going in that direction, it's very difficult to reduce your restrictive monetary policy. It's a lot easier for the Reserve Bank to do it because inflation's heading down, not up. But over there, I think they're on hold. I don't think they cut in July. I think the markets ruled that out. But it does, rising inflation does make it difficult for the Fed to cut. So the market's saying that, maybe they go September, December, we get down to sort of the low 3s, by the end of next year. But they're going to take their time because inflation is taking a very long time to come down. And who knows what the tariffs are going to do? We don't know what they're going to be, let alone what they're going to do to inflation. But, you'd have to argue they're not going to push inflation down, right? They're only going to push it up. So I think the Fed's on hold for the foreseeable future.
We will see. We'll see. So as we leave you now, I just wanted to reiterate where we find this local market. So the S&P ASX 200, it looks as if it has set a fresh closing high at 8,630, up by 0.7%. Just going to double check whether or not that is.
We need some streamers and balloons and stuff, don't we?
Yeah, boy, ring the bell, somebody.
Things.
Yeah, so look, what a way to end this Tuesday. It's just, is it getting difficult to find opportunities, or you just have to go smaller?
Look, there's plenty of opportunities in the market. The market as itself is expensive, and it is, on a whole, you've got 19.5 to 20 times earnings for the market on 12-year forward numbers. And you mentioned reporting season. Earnings are being downgraded. Like, Australian companies are expected to grow by -3% over the next 12 months. So we've got negative earnings growth and almost 20 times earnings. So as a whole, the market looks expensive. But once you go under the hood, there's plenty of opportunities. We talked about some stocks today like Harbin and CSL. They still continue to look attractive to us.
Good. All right. So it is a record finish for the local market. Nice to have you in on this day then, Martin.
Fantastic. Thank you.
Martin Crabbe there joining us from Shaw and Partners. So let's get across, some of the other views on Hub 24, a man that Martin knows well, Philip Pepe from Shaw and Partners, and Rudy Philippek van Dijk from FN Arena.
We'll see a leverage to the share market as a whole. If the share market stays in an uptrend, this share price is very unlikely to sell off, I would say, although it's still a relatively small cap. And it's all about funds inflows and markets going up, of course. I'm happy to stay as a shareholder. Not that I would advise anyone to chase it here, but as with so many quality growth stocks we have on the stock exchange, you put them on your wish list, and when they do sell off, and those days do appear every once in a while, that's when you snap them up. So it's a solid hold for me.
Phenomenal result, massive scale comes with that. If a market's going up, this is a leveraged play into markets, platforms. It's a good way to play, it's a diversified way to play, it's quality business. It is just not cheap. So they've just put out a cracker of a result, I think it was up 5% or so today after, as you say in the chart, multiple bagger over the last 5 years. Again, yeah, probably like Rudy, I can't bring myself to buy it at $100.
It's always about the price you pay, isn't it? All right, let's take a look at some of these market leaders. The aforementioned Hub 24 on the list, finishing above that $100 mark. Life 360, though, yeah, just going gangbusters today. Paladin Energy as well on that broker move. Now, some of the laggards, there always is, PLS, so Pilbara, Sigma Health, Metcash, which traded ex-dividend, Alcoa, and BlueScope Steel down by 2%. Small to mid-cap space, Dateline Resources looking really sweet. MTM Critical Metals as well as Australian Strategic Minerals. Let's go to the other side of the equation, Amplia Therapeutics, Delta Lithium, and Ares Resources. Tonight, we do get the U.S. Empire State Manufacturing Index for the month of July. It's tipped to lift. And then that Consumer Price Index for June, CPI, monthly headline, and core PCI, or CPI I should say, may lift by 0.3%. But we also get earnings, JP Morgan Chase, Wells Fargo, Citigroup, amongst those second quarter earnings reports due. Here tomorrow, building activity. Dwelling starts fell 4.4% in the prior quarter, so we'll get the March data. As we mentioned, a record finish for this local market, record reset, and if it looks like a bull market, smells like a bull market, acts like a bull market, Martin Crabb, my guest, said it is a bull market. All right, so we will see what tomorrow holds. Tonight, the inflation data and those headlines about tariffs coming from Donald Trump and co. And just looking at what we're expecting for the European session that's getting underway as we speak. We've got the EU close to an agreement on some new sanctions against Russia. And yeah, watching for AMSL's 2026 growth outlook, which hinges on second quarter bookings. So we've got quite a lot to look forward to. We'll see you from 9:45 tomorrow.